Welcome back, everyone, to another deep dive.
From AI-inspired insights from farmers.
If you're enjoying what we're doing here, we'd love to hear from you too.
Absolutely.
Hit that like button, subscribe to the channel, and definitely leave a comment telling us what you want to see more of on this deep dive.
We're always looking for new ideas, and we really value your feedback.
So what farm-related mysteries are you dying to uncover?
Right.
What questions are keeping you up at night? Let us know, and maybe we'll tackle them in a future deep dive. Welcome back to the deep dive. We take the source materials you share, reports, research, all sorts, and really try to figure out what's going on beneath the surface.
And today we're jumping into something that affects pretty much everyone. Agricultural commodity markets. It's quite a world. We've got a mix of sources, academic stuff, fact sheets, even a recent USDA report.
Our mission for this deep dive is to, well, cut through the jargon, understand how crop prices actually get set, then explore this growing role of financial speculation.
And really pull it all together to see what it means for you, especially if you're maybe new to farming or just exploring it.
Yeah, because price uncertainty, it's huge in farming, isn't it?
Yeah.
So who's pulling the levers on these prices? How do these big markets work? Let's get into it.
Okay, first things first. The foundation. Commodity futures. What are they?
Our sources explain it as basically a marketplace for contracts. You're trading agreements today for stuff like corn, soybeans, wheat, to be delivered later on.
Exactly. And you've got these two kind of linked markets operating together. There's the futures market itself. Think big exchanges like the CME in Chicago.
Right, where they trade these really standardized contracts.
Yeah, the sources are clear. These contracts specify everything. Time, place, the exact grade, like hashtag 2 yellow corn, quantity maybe 1,000 or 5,000 bushels. Very precise.
And then there's the cash market. That's more down to earth, right? Your local elevator, the processor.
Yeah.
Where the actual physical grain changes hands.
That's it. And the price you see locally, your cash price, isn't just random. The sources break it down. It's mainly two things. That big futures price.
The global benchmark.
Exactly. And then your local basis, which is just the difference between that futures price and the cash price right there in your area.
And that basis reflects local stuff, like transport costs, local demand.
Precisely. Local supply and demand, transportation, storage costs, even quality differences sometimes.
So why would a farmer or, say, a food company even use these futures markets? The sources talk a lot about hedging.
Right, hedging. For a farmer, hedging typically means selling futures contracts. It's like a temporary substitute for selling the actual grain later.
So you're taking opposite positions. You own the grain in the field that's being long the cash market.
Correct. You're long cash, and then you sell futures contracts, which makes you short in the futures market. Opposite but equal, ideally.
And the point is to lock in a price for at least part of it.
Yeah, you establish a price for that main component, the futures price, part of your eventual local cash price. It gives you protection if that big futures price drops before you sell your harvest.
But you still have basis risk, right? That local difference can still move around.
Absolutely. Basis risk remains. But the sources generally suggest it's less volatile, less risky than the futures price itself swinging dramatically.
And folks who need to buy grain, like processors.
They hedge too, but they do the reverse. They buy futures contracts. That protects them if grain prices shoot up before they actually need to purchase the physical stuff. It locks in their input cost, essentially.
Okay, so you've got your hedge on. Then when you actually sell your grain,
You lift the hedge. So the farmer sells the physical grain in the local cash market, and at the same time, they buy back the same number of futures contracts they originally sold. It closes out their position on the exchange.
it sounds like there are some mechanics involved, though. Brokers, accounts.
Oh, definitely. You work with a brokerage firm, open an account, place orders, and there's this key concept. Margin money.
Yes, the deposit.
It's an initial deposit, like good faith money. But, and this is important, if the futures price moves against your position, say you sold futures and the price goes up, you might get a margin call.
Meaning you have to put more money in.
Right. You have to add funds to your account to cover that potential loss on the futures side as it happens.
That sounds risky. Or at least like a cash flow headache.
It can be a cash flow challenge for sure. But the sources really stress this point. In a true hedge, these margin calls aren't really a loss, because that loss on the futures side, it's typically being offset by a gain in the value of the physical grain you're holding.
Because if the futures price went up, your unsold grain is now worth more.
Exactly. So think of margin calls in a hedge more like The cost of your price insurance adjusting in real time. You have to pay up for the protection as the market moves, even if the gain on your physical crop isn't realized until you sell it.
Which brings us neatly to this idea of risk versus opportunity. Hedging, fundamentally, it's about dialing down the risk, isn't it?
That's how the sources primarily frame it, reducing financial uncertainty.
So let's walk through it. Farmer sells futures if prices then go up.
Well, the good news is their physical grain is worth more. The bad news is they lose money on those futures contracts they sold because they have to buy them back at a higher price.
So they miss out on the rally.
Largely, yes. The gain in the cash market is offset by the loss in futures. The net result is a price close to what they locked in initially.
But what if prices go down?
That's where the hedge pays off. The value of their physical grain drops, which hurts. But they make money on their short futures position because they buy back the contracts cheaper than they sold them.
And again, it sort of balances out.
Roughly, yes. It shields them from the worst of the price decline. Their final net price, minus costs, should be near the futures price level where they initiated the hedge, adjusted for that local basis.
And basis can still wiggle around a bit too.
It can. Sources mention basis often tends to narrow or strengthen between harvest and later in the year. If that happens for a hedged farmer, it can actually boost their final net price slightly, but it's not guaranteed.
And for the buyers, the processors who bought futures, same logic, just flipped.
Exactly. If prices rise, their futures position gains, offsetting the higher cost of buying the physical grain. If prices fall, they lose on futures, but save money buying cheaper grain. It smooths out their costs.
The main hurdle seems to be those margin calls, just managing the cash flow.
It's a practical challenge, needing liquidity, but again, the sources emphasize viewing it as a cost of risk management in a hedge, not a speculative loss. You're paying for price stability.
Okay, so that's the textbook picture, right? Futures for price discovery, managing risk for people actually handling the commodity. But this is where it gets really complicated. Based on our sources, there's this other massive force, speculation.
Yes, speculation. This is trading purely for profit on price movements. These traders, the sources say, often have zero interest in ever seeing a physical bushel of corn. We're talking hedge funds, investment banks.
Big financial players.
Big players. And they're not always just trading standard futures. The sources point to things like swaps.
Swaps, that sounds complex.
They are. Think of them almost like side bets on commodity prices. Two parties agree to exchange cash flows based on how the price moves, often without any physical commodity needing to back it up directly. Some sources claim these swaps themselves can push prices around.
And the sources seem to agree that this kind of financial activity in agriculture has, well, exploded, massively increased. Yeah, they call it financialization. And a key driver mentioned is deregulation, specifically the Commodity Futures Modernization Act in the U.S.
How did that contribute?
It apparently exempted a lot of this over-the-counter or OTC derivative trading, like many swaps, from direct oversight, which opened the floodgates, really.
So banks started creating new products.
Exactly. Things like commodity index funds or CIFs. They sold these to big investors wanting exposure to commodities, but then to manage their own risk from selling these funds.
They had to buy futures.
They became huge buyers of actual commodity futures contracts. And according to the sources, they even lobbied to get position limits, the rules capping how much one entity can hold, raised or relaxed.
Okay, so what's the impact of all this? The sources seem pretty concerned.
The central argument in several sources is that this surge in speculation makes prices much more volatile, and it can distort prices, pushing them away from what actual physical supply and demand would suggest. Distort them how much?
Well, one source goes as far as estimating that speculative activity might be responsible for something like 10 to 25% of current consumer food prices. Another study, just on wheat, found speculation explained maybe 6 to 12% of short-term price swings and created these little bubbles.
And this volatility, it hurts people.
According to these sources, yes. It hurts consumers through potential price impacts, especially lower-income families, and it hurts farmers. The argument is if prices are bouncing around because of financial bets, not just weather or actual demand.
It makes it really hard to plan, or even use hedging effectively.
Exactly. How do you hedge reliably if the futures price itself is being warped by speculation? It undermines the core functions of the market, according to this view.
One source even mentioned farmers struggling to find buyers sometimes, even with high prices.
Yeah, an example given was post the Russia-Ukraine situation. Some wheat farmers apparently faced this high futures prices, but difficulty finding buyers because the market was so chaotic and volatile, potentially due to financial positioning.
Okay, but there's another perspective in the mix too, right? About the link to consumer prices.
Yes, definitely important to note. One study looked at Canada, comparing wheat futures volatility to bread and flour prices. They actually found a weak, sometimes even negative correlation over their study period.
Negative, how does that work?
Well, their point, supported by a USDA estimate, is that the raw commodity cost the wheat in a loaf of bread is actually a very small fraction of the final price, maybe only 4%.
So lots of other costs matter more. Processing, transport, retail.
Exactly. This study suggests that volatility in the raw commodity futures doesn't automatically or directly translate into the same level of volatility on the supermarket shelf. Those other factors buffer it or have their own dynamics.
Financialization isn't just about futures trading either, is it? Sources mention land too.
Right. It's also linked to increased large-scale land buying, often by financial funds. They see land as another asset class, maybe a hedge.
And the impact there.
Sources connect this to displacement of communities and often a push towards large-scale industrial monocultures, corn, soy, frequently for export or biofuels, not necessarily local food needs. The argument is this can externalize environmental costs, like soil damage, pollution, and social costs too.
So the takeaway on speculation versus reality
Yeah.
is it's complicated, but there's a strong argument in these sources that the financial side has grown so large it can potentially disrupt the market's intended functions.
That's a fair summary of that viewpoint.
Yeah.
That the influx of financial motives can inject volatility and distortions detached from the physical realities of supply and demand.
Which must make planning incredibly difficult for farmers. How do they decide what to plant with all this going on? They need signals, right?
They absolutely need signals, and sources like the USDA's WASPRA report the World Agricultural Supply and Demand estimates are crucial here.
What's in that report?
It gives the official picture estimates and forecasts for planted acres, yields, supply, demand, trade, ending stocks, and those all-important season average farm price projections for major crops. It reflects real-world stuff like, say, too much rain impacting planting.
So that's one key signal. Can they use futures prices too for predicting?
They can, and traditionally they have. The futures price for a harvest month should reflect the market's collective guess about future conditions. A farmer can look at that, estimate their local basis, and figure out a potential price they could lock in now, even before planting, using hedging.
But there's the catch we just discussed.
Exactly. The sources arguing about excessive speculation say that this very volatility and distortion makes futures prices less reliable as planning signals. If the price is jumping because of fund activity, not just expected supply or demand, how much faith can you put in it for making multi-month decisions? It adds significant uncertainty.
It seems like farmers are often caught in the middle. Sources say they're usually price takers.
That comes through clearly. Unlike maybe selling a niche product, for major commodities like corn or wheat, individual farmers generally can't set their own price. They have to accept what the market offers.
And that market price is influenced by global supply, demand, and all this financial activity.
Precisely. Those are the big forces at play.
So when the sources talk about farmers fight back, what does that actually mean in this context if they can't just raise their prices?
It's less about individual price setting and more about seeking broader systemic changes. The main fight back described involves advocating for policy and regulation.
To rein in the speculation.
Primarily, yes. Pushing for stronger rules for commodity markets. Things like closing loopholes that let trading happen unregulated, perhaps offshore.
And those position limits you mentioned earlier.
Yes, establishing meaningful, binding caps on how many contracts one entity can hold to prevent any single player from having excessive influence or driving excessive speculation. More transparency in the markets, knowing who holds what, and actual stock levels is another key demand.
Some sources also link this to bigger international policies.
They point to institutions like the IMF and World Bank, arguing that historical policies promoting market liberalization and deregulation kind of paved the way for this level of financialization and its potential downsides.
And resistance can also be local, like communities affected by land deals.
Yes, that's mentioned too, communities filing complaints or challenging large land acquisitions linked to financial investors.
Okay, so bringing this all together, we have these complex markets, vital for food, but potentially destabilized by financial actors. For someone listening, maybe thinking about farming, how can they even track market signals without feeling trapped by this volatility? And how does this fit with trying to farm profitably and sustainably?
It's a huge question. Based on the sources, tracking signals still means relying heavily on things like the USDA reports for the physical fundamentals. Hedging remains a tool, but, well, its effectiveness seems challenged by this speculation-driven noise.
So navigating it isn't just about individual strategy.
The sources seem to suggest that truly escaping the trap relies more on those systemic reforms, better regulation, more transparency to make the market signals more reliable and futures more functional for actual producers and users again.
And the connection between profit and sustainability in this picture.
The sources we looked at tend to draw a pretty direct and often negative link. They argue that the financialization pushed the focus on short-term returns, speculation, large-scale land investment, often drives agriculture towards more intensive industrial models.
Which aren't always sustainable.
Right. These models can externalize costs, environmental damage like soil erosion, water pollution, biodiversity loss, or social costs like displacement. So the profit motive, as channeled through these highly financialized markets, is often presented as being in conflict with sustainability goals, not balanced with them.
Are there any market-based sustainability links mentioned?
Some sources mention things like crop rotation as good for reducing production risk, which obviously aligns with sustainable practices. But it's not really framed as a primary market strategy to balance profit and sustainability against the backdrop of financialization. The focus is more on the tension.
So it's a real challenge. Markets that are crucial for pricing our food are heavily influenced by financial bets made far away, potentially creating instability for farmers and consumers, and maybe pushing farming in less sustainable directions.
That's the core tension highlighted. So maybe the provocative thought to leave everyone with is this. If the price of physical grain can be significantly swayed by virtual bets, what kinds of new approaches or changes are needed to make sure these markets genuinely serve the people who grow our food and the people who eat it? We hope this exploration has been valuable. Thanks for joining us on the Deep Dive.
Hitting that like button and smash that subscribe.